We should be. All right, we're live. Build Weekly Roundup, Bnpl Fomo. This is week 16, 2025. I'm Dave Martin with Build Asset Management, and here with me is Matt Dines, CIO of Build Asset Management, otherwise known as Levered USTs. Matt is out in the middle of the desert right now on vacation, so thanks for taking time out of your vacation. Where are you right now, Matt? Talk a little bit about where you are, and I think we're going to tie it into the show this week. So, yeah, give us a rundown.
Yeah, so I'm at an undisclosed location, as you mentioned, in the desert, just slightly north of Joshua Tree National Park. So, nice little stretch of road goes out into just empty, hot nothingness, I would say. But just getting some time with family in. It's spring break, and as the title of the episode, Bnpl Fomo mentioned, I didn't realize this, but our younger teammate Cameron let me know this week. This is Coachella week for everybody out here in the Palm Springs, Desert Hot Springs, Rancho Mirage area. So big things going on. There's an interesting little story to discuss on the Coachella ticketing front. We'll get into that later. But yeah, theme of the episode, Bnpl Fomo. Just living it up out here in the desert. It's a cool week in the desert. I think it's unseasonably cool, chilly here. It's topping out about 70 degrees lately, which is unseasonably cool. So picked a decent week to come out and not get too fried in the sun, as tends to happen out here in Death Valley.
Well, good. Thanks. We'll go through this episode, and hopefully you can get back to some pool time. And then, are you going to the festival this weekend, Matt?
Yeah, I'm gonna go. I've never been to a Coachella, but just grab some tickets. I'll go check it out with my wife and kids. We'll see what all the hullabaloo, or however you say it, is all about. But
definitely not a word
yeah,
that
we'll hop in.
Gen Z uses.
Hullabaloo.
Well, Matt, I know it's been an interesting week. In some regards, we could say that things calmed down in the bond market. So before we get to BNPL, I know you want to talk about the bond market a little bit and the MOVE index. Maybe kick this off. What is the MOVE index? Why do we follow it? And what is it telling us right now?
Yeah, so we got a lot of new listeners coming in. So just for a little set the backdrop. So a lot of things going on in stocks and bonds, your traditional asset classes that most portfolios, as far as Americans are concerned, are allocated to, right? The passive investing phenomenon that's been growing for multiple decades now, and just move the needle between or move the allocation up or down between U.S. equities and bonds based on risk factors like, let's say, your age. I've been kind of reached out to. I don't know if Dave, you've seen this personally. We need to explain Cameron not on video this week too.
Well, yeah,
remind me to hop on there.
Yeah, shout out.
Address it. But let me continue this one first. So I've been asked by a lot of friends, family, peers, with everything going on. This is a bit different than 2022, even where we saw rates lifting off zero, the volatility in the bond market, equities drew down tandem. This one feels a little bit sharper pain to most people who've reached out to me in the last couple of weeks. I don't know if you've had that same experience, but people can tell something's going on, something's different. It feels a bit like a combo maybe of 2022 with the bond market issues and maybe even those early days of COVID where you had that massive equity market volatility. You know, everybody at this point and their mother is apparently got extremely long on the Mag sevens, the large cap techs over their skis, and people are feeling it, like this drawdown that really was felt in equities in particular over the last 2 to 3 weeks, and even still this week there were some sizable down moves in equity markets. So just wanted to set base there with anyone new tuning in this week. There's people out there looking for answers. What do I do differently? And we just want to provide some education, hopefully from the ground up, for just getting your bearings in this environment and helping you come to your own conclusions, dear listener, on how do you position yourself, your savings, to maintain your purchasing power and all the hard work you put into building a portfolio and a nest egg to understand what's going on and navigate what's coming. So with that in mind,
what I'm seeing right now from, and it's not like we're
let's go.
Right who've pulled offers on houses. I know builders who have had houses sitting on the market. You're on the housing front. You're seeing delistings, relistings, price cuts. It's not this cascading waterfall on that side, but it's almost like the behavior right now is a little bit the deer in headlights, and the operative word is everyone's just uncertain. What does this all mean? What's going to happen? So. That I think we're in a really tricky spot, and taking your lens and looking at it from the angle of credit markets, I think is going to be very helpful, because quite frankly, if you tune into CNBC, it's like a 90-10 on their content. If you're turning into mainstream financial news, it's focused on equity markets, equity markets, equity markets, the stock, the sector, whatever, it's up, it's down, and then 1 out of 10 minutes of content, they're talking about the bond markets, credit markets. So I think that's kind of telling why everybody gets a little bit frozen up, and they might be looking at the wrong thing. So hand it back to you, Matt.
So you used a word, the magic word, and I didn't intend to go down this rabbit hole, but I think it should be for the new listener, some discussion. So you use the word uncertain, and you'll hear that word used incorrectly from and I don't want to be a word police here, but in markets and investing, we commonly in our language equate risk and uncertainty, and we don't use the word uncertainty precisely to define the actual phenomenon. So in kind of financial and economics lingo, we use the word uncertainty really to map to the concept of just the unknown, the unknowable that can't be allocated against, can't be hedged. Imagine like true acts of God. A meteor hitting the earth, a massive natural disaster, an unforeseen death, an early death of a major world leader in a position of importance, something like that. Something that you can't position for. It's an unhedgeable risk, right? Versus actual, when we colloquially use the term risk in markets is kind of alluding to or getting around the concepts of what's known in the probability distribution, what things can happen that we can hedge and prepare for, right? And I go down that rabbit hole not to be a stickler on words for the sake of just um, being the pedantic word policeman. What I'm doing that for is for people to understand and actually start thinking about these things. Is it really uncertainty in the sense that these things that these catalysts that spurred the volatility in your stock and bond portfolio, were those uncertain? Like, was it a true meteor coming from down from the heavens and something like the dinosaurs had no clue, like nothing to prepare for? Um, or could we have seen some of these things ahead of time and positioned accordingly? And I'd argue it's more of like what we've seen in the last 3 weeks, especially since April 2nd. They fall under that definition of risk in terms of like what was preparable. Um, because, not to Monday morning quarterback this, but we've talked about this on prior episodes. It was well telegraphed, post inauguration day that the tariffs
Well,
were
even
coming.
before,
And
even
even
before that,
before
it was
that, it
well
was well
reported. Go
telegraphed.
ahead.
If you paid attention to the campaigns, any stump speech, you can find every campaign stop. Trump using um, the language like tariffs are the most beautiful word in the English dictionary. Just kind of that extravagance that we know he speaks with kind of uniquely as his calling card. But we knew this was coming. It should not have been a surprise to anybody. So I would say it leans towards that definition of risk, something that was preparable for. You could have seen around the corner had you thoughtfully, baked in that new or that information into your framework. So just want to make sure we're using the word risks and uncertainty properly, because that informs how we position ourselves as individuals and stakeholders responsible for preserving capital through periods like this. I personally don't uh, want to ever accept the idea that, hey, me individually, as say a portfolio manager, or our peers in the industry, are failing to hold ourselves accountable on behalf of clients when collectively we maybe or
But
maybe
that's a
not should
key.
have
That's
done
a
better
you're making a key point
given what's
right there,
taking place.
Matt.
But
In
that's the thing.
that there is a line between I don't know who you're talking to, but when I talk to people, they're not managing all their own assets, or they're working through advisors, or they're working through some sort of managed portfolio. And so I think where you're pointing out the nuances with those words, and uh, I think the reaction from people who are not in the industry is very understandable. I think I think it's fair to say you're uh, pointing the lecture a little bit at the profession, in that I don't necessarily think that somebody who doesn't manage their own portfolio, retail investor, whatever you want to call them, is on the hook for what you said, positioning every day. I mean, that's the whole point. The whole reason you have this industry. So, um, it is surprising when you have people in the profession who are blindsided by that. I'll leave it at that.
Yeah, and it's a filtering event. We're talking about like these big changes that's going on with this administration. It's something that I think everybody alive today in the industry is in the United States financial industry hasn't had to deal with, right? Maybe in other countries you've seen something like if you're coming from Brazil or another emerging market, maybe you've seen some of these things and you know how to prepare accordingly for them. So you're more perceptive to what's going on, and you don't fall back on just old habits or what's worked in a prior uh, major era in markets. So yeah, I think it's one of those
Sure.
filtering mechanisms. I
Yeah.
would say, yeah, like a
Yeah.
selection event.
Yeah,
So I think
let's move
that's
into
enough on
the
that one.
let's talk
I
about
think.
what
But,
happened in bond markets this week, because my interpretation is that the bond market
yep.
did something very unusual in the last couple of weeks after the Liberation Day, and then things seem to have calmed down a little bit, even while equity markets have still been pretty volatile. So what's going on here?
Yeah, so this chart we've had on the screen for 10 minutes now and haven't talked to um, after that warm up. So, if you'll recall, during that week after Liberation Day, from April 2nd to April 9th, Wednesday to Wednesday, first move we had, the first kind of two trading days after that announcement in the Rose Garden on Wednesday afternoon was really that the Treasury curve was bid. Yields came down. People saw that as a sign to flee to safety, and safety was widely perceived on the initial reaction to be get into U.S. Treasury bonds. But starting on midday Friday and then into the weekend, and then this continued up until Wednesday, Thursday of last week, April 9th, April 10th, you saw the Treasury curve start to sell off, especially on the long end, right? And that's where if you're the key one of the key players responsible for maintaining the health of the U.S. financial system, as well as making sure Treasury markets are functioning and things aren't getting disorderly. During that Treasury sell-off, you saw yields hit a key level, and that's when you saw Donald Trump come out on that Wednesday tweet on April 9th and reverse out of the Liberation Day policy. Not fully walk it out, but the 90-day.
Looks like
My wife, good. All right, I'm on my wife's MacBook, so I'm getting these pop-ups that the audio changed
I
to her
think you're
AirPods. So
back
hopefully
now.
it's still
Thanks, Matt.
coming
Yeah, you
in.
did. You dropped for about 5 seconds. So,
Okay.
yeah.
Okay. All right. So on that note, when yields were selling off, this instrument or this index called the Move, which I'll get into details about later. What it's tracking is really volatility in the U.S. Treasury debt market on a forward-looking basis. So what you're tracking here on this chart is the price of derivatives or options that are used to hedge against U.S. Treasuries. So 2 years, 3 years, 5 years, 10 years, 30 years. This index is constructed to take the implied volatility, which is an equivalent way of saying the price of risk, if you will, for hedging U.S. Treasury volatility in the bonds themselves on a 1 month forward basis. What does that mean in practice? Well, what it means is your major financial players who were using these instruments. So when you think about an implied volatility on an option or a swap or similar derivative instrument on a U.S. Treasury, why would you use that? You use that if you're a major bank or financial institution to hedge out risk of, could be your own bond portfolio specifically, or it could also be kind of a hedging instrument to hedge out risk of, creating other credit downstream. So mortgages, long-term debt, project finance, all types of things. And when you see this index start to go up, it means that cost of hedging is increasing. And when you see it start to hit levels like 140 or 135, like breaking through, what that means is it is getting extremely prohibitive from these financial institutions from hedging the risk in their treasury book. So as soon as this gets super elevated, you'll start seeing bonds, in particular U.S. Treasuries, but also all credit, like liquidity starting to back away. Economic transactions not get done because the cost of hedging out interest rate risk is becoming prohibitively high. And you start risking, financial seize up throughout the system. So that's what we saw, the buildup after that initial reaction to the Liberation Day announcement in the Rose Garden, which seems like a distant memory at this point, but it was only about 2 weeks ago, which is somewhat surprising. It's like in this kind of era, days are weeks, or days are the equivalent of weeks or months. It seems like time just goes very, very compressed in a lot of action is occurring in a very small amount of space. But this was only 2 weeks ago, and really that is a key indicator that would tell if you're the front runner responsible for driving these parties, well, it's time to pull back, step it down a little bit, let markets cool off, and we called that in last week's episode. Right, with that analogy to that boxing match, Hagler versus Hearns, the bell rang after round one, and this is exactly what we've seen in the week since last Thursday. We've seen the move drop considerably. So as of earlier today, when we screenshotted this on the terminal, the move had fallen down to 119. Now that's still a very high level. But it's really the rate of change and direction that is the key. So I would say we're still at a not an extreme reading, but it's still on the above average end for sure. It's not necessarily easy to get hedging transactions through. If you're a financial system, it's still very expensive because there is still a lot of risk in front of us as these trade negotiations and currency negotiations continue to play out. But in the bond market in particular over the last week, this has been kind of currently commensurate with yields coming back in across all areas of the curve. So 2 years to 30 years, yields have traded lower. You've seen credits, just from my personal anecdotes as a trader on, say, electronic all-to-all platforms. The last, say, like April 2nd to about, I'd say Monday this week or Tuesday, was one of those nice windows. If you're on the buying end of transactions, it's very good for you if you have the capacity to absorb the credits that the rest of the market is kind of like spitting out like a piñata getting hit. It was a good time, but I've noticed, as move and other, volatility measures in the treasury market have come in, that's slowed down for the time being. So all in all, we've got a week of kind of settling in. As we talked about last week, we can't run up dialed at a move 140 for long, right? You're really risking the wheels falling off the bus in the sense, and that's really at the core of the financial system and treasuries, and that'll just continue to work its way down across all asset classes, even equity markets. So that's been the key headline this week, I'd say, from the bond market perspective, has been kind of a settling down,
Matt,
if you will.
one final point on this. Let's talk about the Fed really quick. The exact quote, I don't think I have the exact quote in front of me, but Jerome Powell spoke, and he said that there's concern that there's going to be potential tension between the dual mandate that the Fed has in terms of price stability and low unemployment. And can you talk a little bit about if the bond market gets more volatile, if treasuries from 10 years and out start to sell off again, what's the Fed going to potentially have to do in that scenario? Yeah.
So two different things there. I'll take those separately. Let's take that definition. What happens if we get into the treasury market situation like we saw last week, where policy has to come in and provide some sort of stability mechanism? I could actually tackle that one easy. It's a very easy, Band-Aid solution. I think we saw when I say easy, it's never easy, right? It costs you something, but it's not that complicated, right? With the March 2023 episode of Silicon Valley Bank and other kind of failures, we saw the creation of the BTFP facility for short-term borrowing, right, to kind of provide some lender of last resort kind of functionality to banks in exchange for their treasury and agency debt. It was like 14 different quasi-government, issuers that you could post the bonds to as collateral in this. But those were for 1 year borrowing, and it was indexed off of the 1 year SOFR swap rate. And the subject of those lending arrangement was to like the U.S. banking system, right? In this case, like the Treasury market functioning itself, you're actually coming in to work on a different patient. It's not the banks you're working on in this time. This time it's to support Treasury market functionality and liquidity. And so the target of that would be your primary dealers. You can even go your smaller broker dealers, but they wouldn't be as important. You may actually extend it beyond the primary dealers to the large hedge funds like Citadel, Millennium, et cetera, for support of the off-the-run treasuries, because they are a huge part of your bid ask market for the off-the-run treasuries. And what I mean by off-the-run, it's a U.S. Treasury bond that was issued, in the past, and it's got some seasoning on it. It's got some age. So let's say it's the 10-year from last year. Now it's a 9-year bond. What happens is that bond will slowly, in the months after it first comes to market, it'll find for the majority of holders its final balance sheet home. Someone like a pension, an investor who's going to hold this thing into maturity, or at least plans to. But for liquidity trading on those, let's say you need to sell it, it's nowhere near as large of a market as what are called the on-the-run treasuries, which are they're fresh, they're brand new. So for those off the runs, you actually do see a lot of the liquidity support coming from your smaller broker dealers, or even your hedge funds, your Citadels, Millennium, et cetera. And like they're providing a necessary service. They're using their balance sheet capacity to create liquidity in these old off-the-run U.S. Treasuries. So my point there, why I went down that road, you might, unlike the BTFP, which was just for the banks, a new facility for Treasury liquidity support may include the primary dealers themselves, but also, other classes of liquidity providers. So other broker dealers, and then also the hedge funds who are engaged in what you commonly hear as the basis trade, but they're heavily involved, and you really need them here. Otherwise, the entire financial system as a whole, the banks, the primary dealers, they don't have the capacity to provide bid ask in size liquidity support for just the massive amount of treasury debt that we've accumulated. So, love it or hate it, these hedge funds who get a bad rap in the headlines with the basis trade, that comes up every time the market comes into, or every time the treasury market goes into a tightness in financial conditions. Always, first culprit kind of mentioned in the headlines you'll see is these darn levered hedge funds running the basis trades. You need them though. Otherwise, you would, if you're holding a more seasoned, say, U.S. Treasury bond, or heaven forbid, a seasoned government agency bond with even less liquidity support, you may not have a liquid market to sell into. So these players are providing an extremely important service to the health of the financial system. Now, all right, that covered. The solution here, in my mind, for if and when the next kind of liquidity tightening does occur in the treasury market, and this could be next week, next month, next quarter, next September, next year, somewhere down the horizon, but it will happen again. The solution, in my mind, from a Fed facility standpoint, looks like a new spin up, like BTFP was just created out of thin air, or even remember the repo rumble, September, October 2019, new facility just created, spun up as a Band-Aid stopgap on the problem. This one seems pretty straightforward. The problem here is the longer duration treasuries, let's say 10-year, 20-year, 30-year, and then the off the runs as well. You need some sort of liquidity support mechanism. So what you could do is spin up, similar 13-3 facility operated by the FRBNY, Federal Reserve Bank of New York. And instead of BTFP, which was more targeted for short-term collateral, so treasuries, agency debt on the front end of the yield curve, you would post it as collateral, prove to the bank that you had IOUs that were money good, right? And you would borrow at a rate called, it's the SOFR 1-year swap rate. This is where we can go in. I don't think we want to spend too much time on this, but why charge at the SOFR swap rate? This is what the banks and financial institutions are requiring from each other to enter into a swap transaction to hedge or to trade in or out of fixed or floating rate on one end of a trade. That swap rate is below the rate of treasuries, right? And why does that happen? It's a deep rabbit hole to go down as well. But essentially, what's driving that dynamic is there's too much sovereign debt. Like there's too much debt to accommodate. So the swap rate is going to fall below the nominal rate of your U.S. Treasuries themselves. Why is that important? Well, in these facilities, if your swap rate that you're borrowing is indexed to is below the rate of the debt itself, if you can actually hold that trade on your books at a positive carry. And what I mean by positive carry, the yield you're earning on your IOU, say it's your treasury bond, less the rate that you're paying, right? Your cost of financing. If that spread is positive, you have positive carry and you're just making money over time. You're adding bips every day. So the same playbook that the Fed rolled out as a stopgap to the liquidity squeeze that was driven by banking failures and first quarter and into Q2. We saw it with First Republic as well. The solution was the BTFP, right? Same thing here, right? If we need to support 10-year, 20-year, 30-year, we need to prevent the rates from spiking, right? Well, just to provide liquidity support to your dealers, what you can do is open a facility where your dealer posts their bonds that they're holding and that they need to make a market in. They post those. You post a 10-year or 30-year Treasury earning 4, 4.5, or maybe it blows out into the 5 level that, you kind of see on the charts as a key level that gets defended. Let's say you own that debt, you're holding it and inventorying at 5%, let's say, and your business is you want to make markets in that. You're providing liquidity. You inventory this bond to buy and sell to your counterparties, and that's kind of the nature of your business. What happens is when that inventory starts to sell off, you see the yields blow out in the treasury curve. What's actually happening there is your market makers are stepping away. They don't want to inventory that bond because the market is moving quickly on them, and that's where they can lose a lot of money. And it's just because they're like anybody else operating in the economy, they're trying to make a profit. They're not going to sit back and just take those losses for charity work, right? So to kind of step in, and it also becomes unhedgeable, right? The treasuries, the futures market will blow out back off as well. Move, like we talked about, move at the beginning of this live stream. Move blows out, the volatility, which is equivalent to price of these options, starts running away from you. You can't hedge your risk, right? So what do you do as a market maker? You just flip your sign from open to close. You sell and you step away. So what the Fed could do with a facility to step in, if treasury market liquidity is your desired objective, like maintaining the functioning of these markets, you can't do it. You can't force your dealers to step in and risk massive losses to their own balance sheets. What you would have to do is incentivize them to keep holding an inventory of these treasuries. So what you would do is open up a collateral window where your primary dealers, your hedge funds, just your broker dealer community, some of these are banks themselves too, but they could basically borrow from a facility on longer duration bonds. With BTFP was more, let's use your front end collateral. You post your long duration treasuries, and then you borrow at the swap rate, similar to what we saw in the borrowing index rate for BTFP. And right now, that swap rate, you'll see the negative swap spreads, right? And they've gone. You'll see these in headlines. If like on Liberation Day you saw a 10-year or 30-year spread, like this curve is massively inverted as well, as opposed to the nominal treasuries curve, right, which is now positively sloped everywhere except for inside of the front 2 years. We're just waiting for the last 100 bips of cuts on the front end to the Fed funds rate before you see a positively sloped nominal treasuries curve throughout. The swap rate is actually massively negatively sloped. So the more you go into the future, like a 10-year or 30-year reference rate, your swaps are technically pricing like at least 75, maybe getting close to 100 bips below the nominal treasury curve the further out you go. So that massively inverted swap spreads curve is actually kind of incentivizing. It's set up very well for this liquidity support to come in the next time it's necessary. So that'd be mine. Like if you're trying to read the tea leaves or see around the corner for what might be coming next, the next time we get close to the situation where we need the referee to ring the bell, get saved by the bell, kind of like we were with the Trump tweet announcing the 90 days extension this past Wednesday. The next time around, the push comes to shove. This would be like the type of move you see announced on a late Sunday evening to come in and support. And depending on the volume or the size necessary, this would, in my opinion, fill in at least the next bout of illiquidity. The next time this rears its ugly head and becomes a problem, which in my kind of skepticism is more of a like when, not if, if that makes sense.
Stuff. To close this out, Matt, is the Fed, in order to make a decision like this, is the Fed looking at levels, or are they looking at the rate of change in a bond sell-off?
Both. To fill in both ovals. Yeah, the move at like 140, 135, like once you get to the point where like the market is breaking down and financial institutions can't hedge, interest rate risk with transactions, like once the cost of these instruments is getting prohibitive, they're watching for both level. So, all right, you hit the area, you move from green to yellow to red. It's time to step in and do something. But then, so rate of change, like I said, rate of change, like how fast you're proceeding. And then from levels, you're also looking at, from Treasury standpoint, level matters on interest rates themselves because you have to finance the government, right? And at certain interest rates, just given the debt buildup that's taken place, level matters on the yield curve as well. It's extremely important. We've just crossed over the Rubicon in the last 6 months where total interest outlays exceed defense spending, like things like that. So in terms of what the government is able to afford in terms of interest costs, like, yeah, those levels on the yield curve are being watched very closely and defended as well.
Do we want to move on? I know I asked you a two-part question, but I know we've been on the move index for about 30 minutes. I think maybe next week we can talk a little bit about potential like rate cuts at the front end of the curve. Do you want to comment on that right now, Matt, or would you rather move on to our next topic?
Yeah, I would just where markets are pricing. You look at bonds and associated, forwards, all of that on the front end. There's more rate cuts eventually coming as the system slows down. You're even seeing, even today, another headline: Trump is uh, kind of publicly airing his frustrations with
Yeah.
Chair Powell and the Fed for not cutting. ECB just cut again today.
And we've seen this before
So
in Trump
there's
45. We saw the exact same thing. The yelling at Powell over. Well, he was doing it over Twitter back then. Now he's doing it over Truth Social, but it's the same.
yeah, yeah. So the Fed is going to be slow. They're not going to do everything everywhere all at once. They need time, and they need markets to give them the cover to do things like, say, slow down QE, as they did last FOMC meeting in March, and then interest rate cuts, will resume at some point in the future. But it's very important to the Fed that they don't be seen as taking like a hero's role and say, like, we're going to come in and solve the problem, because they know they can't, right? They have to be slow. They have to be late by definition, um, because they also don't want to, publicly show their hand that they came in to save, the situation. Yet the same, outcome, the system needed saving in the first place, materializes. So you're really walking a tightrope, like playing this confidence game that everything in monetary policy really boils down to. And the worst possible situation you can be in here as kind of an FOMC chairman would be to be exposed, like the man behind the curtain, right? Wizard of Oz, like, whoa, you weren't actually all powerful. So there's some of that. Um, but there's also, there's a lot of dimensions to this. We could talk about this for a long time. Um, but yeah, eventually rate cuts, there are more rate cuts coming, but that alone isn't like, it's what is it, like it's not enough to solve like the gravity of the overall debt situation and the reality of the dynamics. Like it's just like a knife to a gunfight, these next 75 to 100 bips of rate
Let's
cuts.
move on. Yeah,
All right,
gold.
let's talk about, yeah. So if interest rates are the knife to the gunfight, well, gold, from the central bank's perspective, is that higher grade weapon, right? And um, you've seen it's been years in the making, right? Central bank accumulation of gold as a reserve, or a share of reserves on balance sheet. Um, and this one's been an obvious bull market up and to the right. Uh, well, since 2016, but really this latest wave of breakthrough, out of that key $2,000 level finally, after a lot of sideways consolidation, um, initially from that kind of major COVID easing in 2020 into 2023, when we finally saw gold break out of that $2,000 just key mental level with market participants. But ever since, like, it's just been picking up, and the drawdowns have not been uh, very long lived, right? They've been bought on, the gold's been bought on dip um, throughout the last 18 months, and we've seen that really pick up, especially this week. So that Liberation Day kind of week, where we saw a lot of drawdown, not just treasury bonds, but stocks. Gold did drawdown as well. Came back to that $3,000 level where, we talked about gold breaking through 2,000, like it just ripped through 3,000 so far. Hasn't had any major retracements. But in the last week, as the referees kind of called in round one of that Trump trade war version 2.0. We've just seen like gold just break through another keynote, like $3,300. So it just keeps going, right? And going back to that new listener who wants to kind of think about, what do I do now? Stocks, bonds, like these things aren't working for me anymore the same way they were over the last 40 years. Or, if I'm, younger, in a younger cohort, a millennial, Gen Z, et cetera, um, they're not working the same way. My Magnificent Seven, large cap techs, those aren't working the same way either. Um, what do I do? And so I'd say in the last month or two, gold has been picked up uh, by a broader, I'd say, cohort entering the trade, right? So if you think about it, what do I mean by that? Well, gold breaking out of $2,000, it's like no one noticed, right? If you know that Jurassic Park meme where Newman from Seinfeld is telling is it Sam Donaldson, David? Do you know
Oh,
that
the
actor
Dodge said
from
nobody
Jurassic Park?
nobody
That
cares.
scene.
Yeah, yeah,
It's like, see, nobody cares.
yeah. Nobody cares.
Nobody cares. Like it
Nobody
was like gold
cares.
breaks through 2,000. Nobody cares. Um, it just truly didn't matter. But you see it in the kind of slope of these lines for this bull run that gold's been on. Starts off kind of flat, steady. It's only your diehard gold bugs who are like, the central banks are buying. I'm going to keep buying gold. I think it's a little more kind of participation from investors throughout the market as the trend is becoming more and more apparent. Others enter, accumulate. But I'd say since January in particular, the slope of this line, and you can see it, the red, it's obviously it picks up, right? So you're going from a slope of, let's say, zero point 0.5 to 1 to 1.5 over time. This is what happens in bull markets as you get later innings into a run. Um, More and more of, let's say, the broader public, the less informed investor starts to come into this trade because it's working. Um, and eventually, what you see is in the late innings, not in all cases of a bull run, but often when you start to see the broader public come in, that last wave in price just goes like starts to go parabolic. And this doesn't mean that gold can't go further from here, or that even on a longer time horizon, 2 years, 5 years, 10 years, which I'm convicted of as well, gold is going higher from here. What I'm saying here is in these stages of a bull move, um, late in the innings, you start to see that uninformed investor come in the markup phase, and this is where a lot of the most convicted who are buying, let's say in October 2023, who are in this as just a trade, not like a long-term gold accumulator who is stacking gold coins in their vault, is like, the truly, deeply convicted, like gold bug is. But this is where you start seeing the or profit taking come in from those in the trade for the longer term with the lower cost basis start to offload some of their holdings onto the newcomers into the trade. So whenever you start to see a chart moving, parabolic or heaven forbid exponential, that's a sign that the trade is starting to enter a blow off top. Doesn't mean gold isn't going further in the long run, but for a lot of participants, like gold was very under-owned, I would say, across multi-asset allocations, just across the board, especially like considering U.S. investors. Most people, if you ask them what's in your financial portfolio, they'd say 60-40 stocks and bonds. Gold? Why do I need gold? We've talked about this before, why gold is important for, from the credit bubbles perspective. You have to mark up your credit against something. Otherwise, you risk your like a really painful deflationary deleveraging. So gold makes sense in a lot of regards because it's what the central banks, and in our case, the U.S. Treasury is holding, and you can monetize away a lot of bad debt, unproductive debt that's been created over the last, 5 decades plus. Um, but in the intermediate term, in the very short term, those coming into this trade late, um, you're risking coming in when this markup is getting particularly sharp, and this is where if in the last 18 months if you're coming into the gold trade, you really haven't had to weather much pain, right? It's been just buy gold, buy dips. And the amount of like gold just hit another new all-time high this week. I think is key takeaway. I glossed over there, about 33.50 an ounce. You really haven't had to absorb any significant drawdowns or see people, liquidate a position out of the trade. There has not been much pain, and from my perspective, that's setting up, especially for broader participation starting to come in and see gold as a safe haven to their stock and bond holdings, to their real estate holdings. It seems very likely in my case that there's going to be a situation where the market forces those newcomers to weather some pain in the trade, because just the way financial markets operate, you can't have trees just grow to the sky. Lines just move continuously up and to the right with no volatility over time. Otherwise, we'd all, own yachts off the coast in the Caribbean, right? and be yeah. So that's what I would be watching for here, especially in gold. You're starting to see that that kind of, it's not quite euphoria. If you remember 2011, 2012, you had Super Bowl commercials for cash for gold. But you're starting to see broader market interest from, mom and pop retail investors who are starting to realize, hey, maybe I should diversify out of my 60/40. So if you're late coming into that gold trade, I'd say obviously it makes a lot of sense as a balancer, especially the heavier you are in your allocation. If you're only U.S. large cap equities and only fixed income, I'm sorry, but that's not actually a diversified portfolio. And contrary to kind of what you've been told for especially the last 15 years from the financial industry, with kind of the extreme pushing on this move, like just passive investing, TDF, 60/40, you're not diversified. But to start rolling into this trade, timing does matter, right? So if you're coming in right now at an all-time high, gold has a ton of momentum behind it, but the more vertical you see, the higher you see that slope of that trend line going, the more likely a pullback becomes, just because you're going to eventually run out of buyers. The higher price goes at this particular point in time. Doesn't mean these levels won't become great entry points on a longer term time horizon. But my point here is, in the short term, you may, if you're coming in late and just kind of, I think to use the 2021 lingo, aping into this trade, this may be painful for you. So be careful here, especially if you're a newcomer into gold. But that doesn't change anything about my belief, or others belief about gold and their conviction, in particular in that asset as a good store of value, a candidate for a portfolio over the long term. That's not what I'm saying here. I'm just saying this is a time, particularly if you're holding zero gold and you're trying to start building a position now, this may not be the lowest risk time to do so.
Matt, you and I are both pretty bullish on Bitcoin as a better store value, and you see it in
Yep.
those markets as well, right?
Let
There
me,
are clear points where the line just goes straight up, and you're thinking, okay, this is, yeah. Go ahead.
Yep. Let me hop in
Right.
right there, because I don't have a Bitcoin slide, but yeah, I'll say that. I'll agree with you there. Bitcoin, in my opinion, is a more preferable, from my research, analysis, understanding. I'll just personally, Bitcoin I view as more a better allocation for the desired features, properties, etc., than gold. And if you're looking for different assets to rebalance your portfolio into because stocks and bonds aren't working. Right now, you're doing it with the rest of the market really hopping onto this trade as price is moving vertically. There's a lot of interest right now in gold, especially, it's gold's time in the sun, right? You're going to start seeing gold show up on the front page in a positive context. The time you want to be entering the trade is when it's unpopular, right? You're riding a longer term secular bull wave, but it's not making front page headlines where everybody's buying in, driving price up, and um, you're setting your entry point into the trade during a markup phase of a market cycle. What you want to be doing is going into the capitulation phase when everybody else is like, oh, this is so ugly. I would never want to own this. Buy gold and, buy anything in September 2022, right? When everything was at the bottom. But from an obvious, like everybody knows buy low, sell high, but so many of us just, we're not wired to do it. Like the dominant majority of people just don't, we chase assets as they're moving up fast because we want those same returns. And as much as we believe past performance is, or as much as like our smart thinking brains know past performance is no guarantee of future results. We still are trend followers and we just want to chase that fast moving thing. So this is what a lot of people with our lower functions of our brain, going back to evolutionary roots and my understanding of this, we want to go after the shiny object hot thing. Whereas, hey, if I just slow down, think about this, what I should be trying to do is buy those assets that give me the features I want that I can have conviction in, but do it when like against the grain of the crowd when everybody's lined up to buy it. Hey, I want to go over to the store and buy this position when no one's talking about it, when it's out of favor. And right now, obviously equities are broadly out of favor, right? They're trending down. But we'll talk about what Dave mentioned, since you brought it up, Bitcoin, right? Bitcoin trading about 84,000 right now, may trade lower from here. But my point is offers, if you look at the reasons to own Bitcoin, it fills in a lot of basically one-to-one overlap with the core reasons that the same person who's buying gold at $3,300 would tell you they're looking for in their portfolio holding: a preservation of capital, purchasing power, etc. My opinion, Bitcoin offers that in a better facility. It's much more easily verifiable, custodiable, transferable over the internet, etc. Won't get into it, but my point is, you want to buy low and sell high. You want to go get your shopping done when your item you want is on sale. And right now, the momentum in Bitcoin, the interest in Bitcoin is very low. So this is, in my opinion, like if you weigh your odds, if you want to buy gold right now at 3,300, by all means you can go do so. Or alternatively, that Bitcoin sign is just flashing right now on sale, and most people won't take this advice, or even if they're not going to buy it, and say, hey, go do some research on it. Go buy a good Bitcoin book, and I can give you one right now. Go buy Nick Baccia's Layered Money, right? Or something like that, and just do your research if you haven't yet. But this is the time you want to buy low, sell high. And this is that window of opportunity where, hey, if you're buying into gold at 3,300, doesn't mean it's not going higher, right? I think all the players are there, like U.S. Treasury, central banks, all of them want to see gold go higher. But if you're not willing to take down, if you can tell yourself right now, if you're placing an order to buy gold at 3,300, will you be willing to hold it? How will you feel if it retraces $400, $500 from here? Because that could very well happen, especially as an asset, its chart starts to go parabolic as we're seeing. How will you feel if it's down $400, $500 from here? And if the answer to that is you won't be able to ride out that pain, and you can see yourself, put yourself in those shoes, 3 months forward, 6 months forward, and saying, hey, can I write out a $500 drawdown? If you're that person who's going to sell because you have no conviction, I'd probably encourage you to step away from the keyboard, right? Because you're doing the exact opposite of good investment. You're literally buying high and selling low. So I guess that's my public service announcement of the week. Be careful, and where you have the opportunity right now to buy low, Bitcoin's in a
Yes.
nice little drawdown here. So it's time to. I invite you to research Bitcoin, do some analysis, and start
Conviction
forming some
does
convictions.
not come from looking at a chart over a month, 3 months, or even a year. Um, Gold's high conviction, Bitcoin's high conviction. You gotta do the work, and you gotta be willing to ride it. So good advice from Matt Dines. Let's. I want to
Yep.
talk.
All
Well,
right.
Matt wants to talk about
Cool.
now. United Healthcare. This is we're kind of doing a bit of a smash cut here, talking about gold and Bitcoin. Now we're going to something that is um, healthcare. This is a part of everybody's life. This is a major component of everybody's life. You just can't go a month, 2 months, 3 months without probably interacting in some way, shape, or form with the healthcare system. So what is going on with United Healthcare, Matt, and why are we talking about this week?
Yeah. So we covered all the major asset classes actually, but I haven't shown the key charts for the move. We covered bonds, we covered gold. Um, why United Healthcare, right? This is our just coverage of the equity markets broadly, but we're going into the micro here with the largest insurer in the United States and a very like large cap equity. Um, so today on United Healthcare's earnings announcements, a couple of things. They had a miss, but then management cut guidance for the remainder of the year ahead on the back of their Optum and Medicare Advantage business. So this kind of plays with everything, right? There's a lot of connective tissue between. Um, didn't intend to make that analogy here, talking about a healthcare company, but I did. Um, Shamelessly, I guess. But this is related to what we're seeing, like with the government thing with Doge, right? Cuts. So a lot of United Healthcare's revenue, like the largest payer in the U.S. healthcare system is the federal government. It's Medicare and Medicaid, right? They're the behemoth, and they contract and work with large insurance companies like United Healthcare. Um, and one of the things you've seen from Doge is a clampdown on how the government pays for like the service provider or they don't. And healthcare doesn't provide any healthcare services. They're just all a middleman. They're payer functionality, man in the middle type of thing. But with the Doge initiatives and others to tighten up federal spending, there were some changes to how the government will pay for its Medicare Advantage insurance providers, and that was a big hit to the United Healthcare stock. So they announced they missed earnings for Q1, but then also they brought down guidance. And for any player in the U.S. economy, if the U.S. government is your largest customer, um, they're in a situation where they want to lower their bills, right? So it goes to like, if you're not on the top of the priority list, like defense, for example, things that are a must-have as we're getting into an era where conflict amongst nation states is trending up. If you're on those other like below the fold items where you can be like if you're a cost center and there can be cuts and savings, um, you're at risk, right? And that's exactly what we're seeing with United Healthcare. So that cut to guidance today. If you're looking, remember we're talking about equity markets, the volatility. The trend is down. We're setting lower highs, lower lows. Um, this example here, where you're seeing with United Healthcare, you get a hit on both earnings, right? You missed earnings, you cut guidance, so you're like, all right, we're going to have a lower earnings number. You're now also exposed to the Um, the other side of a double whammy, which is like your multiple coming down, which is part of a broader trend, haven't really talked about, but international capital. So European investors, Asian investors selling U.S. equity holdings, right? So playing with that trend line, you've now got the double whammy where you're going to start being hit with lower earnings, but then also lower multiples. So this is we're talking about these things. How do I position my savings, right, to preserve their purchasing power over time? These kind of best practices that we've been told and ingrained over our whole lifetimes. Hey, you buy stocks and then you hedge that with bonds and 60-40, easy button. It works. Chart goes up and to the right at a near 45-degree angle with low volatility. This kind of what we're seeing today from United Healthcare, it's part of that same trend we've been talking about of a big turning of the tides on a
Yeah,
multi-decade
Matt,
trend.
it's not visible. Matt, it's
Yeah,
not visible
the
here.
ship going
What
in
is the
another direction.
timeline on this chart? Where does that start? Let's
Oh
see.
yeah, sorry, I cut that with the footer. So this is going back
Okay.
about 3 years. So if I don't have, I'm on my wife's MacBook, but I can't say it. But this goes back to I want to say like 2023. So United Healthcare has stalled out. It's if you look here, this is it's an oscillating chart on a flat trend line, and you've seen this $450 per share level kind of threatened, but generally it's held up as support. Um, you've got a major move down from 600 to 450, down 25%. Like, so you've got, well, you had another one at towards the end of Q3 last year, if you recall. This is a company who's dealing with
Yeah.
a lot of idiosyncratic volatility. If you recall the headline in December, a key
CEO.
executive of the
Yeah.
company was murdered, allegedly in New York. When I say allegedly, there it's just following whatever. Like, all right, did he like the what do you call Luigi, what have you? He hasn't gone through due process, all of that, but they were dealing with a very particular situation in specific with executives
Yeah.
as a target of violence. Um, but I think that's just kind of a sign of the times, right? The healthcare is a key issue right now that a lot of people are upset about with affordability and costs. So housing, healthcare, all of those key things that people expect, right, as part of their base level of like Maslow's hierarchy of needs. With what's going on in a late stage credit bubble, those things become uh, more and more unaffordable to people. Eventually, that kind of causes these snaps in society. And I think what we're seeing here with United Healthcare is like a poster child symptom of that. So, we're talking about some really heavy stuff here all around, and a stock having this sort of uh, red day is by no means nothing to be excited and gleeful about. I think it's more of a sign of the overall poor health that this system finds itself in. But what we're saying for United Healthcare, like the key thing here, the reason they missed earnings is because of the debt situation, right? And so you just trace these things upstream. What's the actual root cause? Ask the Toyota five whys, right? Why? Do these things keep happening? And it comes down to the end of the day, it's the debt bubble, right? The Treasury's deficit situation. So we're finding a lot of things to be angry about, and just we want to find the easy button for blame. But the answer is it's the debt, right? It's the money, it's the monetary situation. Um, but we're broadly not at the point where we can accept that, in my opinion, still. So this kind of United Healthcare situation, I think it's your poster child for equities this week. Um, if you're, and this is a major component of both the Dow and the S&P 500, this was one of the largest divergence days, though. Like, interesting kind of factoid. The way the Dow index is constructed, it's more of a price index, and then S&P 500 is market cap weighted. This drawdown in United Healthcare actually
Yeah.
caused the biggest divergence between the Dow and the S&P that we've seen in a long, long time. But I think it is kind of a good illustration of the overall backdrop that's facing your U.S. large caps right now and what's going on in the U.S. economy.
All right. Let's
All right.
we did
Oh, one one last
well, we've
final
got
chart.
yeah,
I'll be
we've got
very
two
quick
more.
on
We've
this
got
one. This is the
dollar.
dollar.
Let's talk about this, and then our last is BNPL. So
Yes. All right. Let's. I don't want to talk much about the dollar, but as you can see, this very precipitous drawdown and just the red candles continued this week. The dollar is weaker. Markets are closed for trading Friday, but we'll get an FX print like for international banks. Setting the FX rates for dollar euro, dollar yen, etc. Um, but dollar's been dropping, very quickly since February, I would say, really since the Trump-Zelensky White House meeting, which went infamously badly or poorly, I guess would be the right word. Um, but the just the speed and kind of magnitude that the dollar has sold off. Like, you're talking about a 10% drawdown in a currency. Like, in FX markets, that equates to as close as anything being described to as like a crash. These things are not supposed to be, um, this volatile. So, um, at some point, the dollar is going to be due for a bounce. And the dynamic we've seen, kind of like the fiscal situation we're in, dollar up really is uh, like there's some necessary conditions you would expect to see, including rates up. When I say rates, I mean U.S. Treasury interest rates up, but then also the dynamic when we see dollar up, rates up, you see risk assets bounce as well. Is kind of the market environment we've been seeing lately. So equities bounce, gold kind of trades differently lately, the last 1 to 2 years, but like perceived risk assets like Bitcoin up as well. So I would watch this. Eventually, you'd expect the dollar to start getting bid, unless we're just gonna. At this rate, the dollar will be at zero by the end of July, right? Something like that. So eventually, the speed of this decline will slow down, maybe even bounce. But that carries a lot of implications for like the cross asset class response. So if there's one thing I think markets, if you're a more active or fast player in markets, or you're a portfolio manager and have to be quick to respond, I would say a bounce in the dollar is something to watch for, which could put a lot of people on off sides in the coming days, weeks, in shorter term time horizons. Um, but still not a great spot. I don't know. It's a great, anybody can look at that dollar chart and expect to get bullish. And also you can see if you zoom out since 2023, especially, what you're seeing is lower lows and higher highs. So you're actually seeing the chart kind of zoom out, or like the range of outcomes is getting wider on that volatility as this kind of ping pongs back and forth. So this is where the moves can get sharper and more pronounced, which makes it harder. We talked about the move index. Hey, when the price of those options goes up, hedging becomes more and more expensive to hedge out, say, U.S. Treasury interest rates or credit, especially if you add more duration or credit risk on top of say some sort of instrument or some sort of deal you're trying to get done, etc. It's the same thing in FX, right? This cone is broadening, which means your volatility is increasing. And you're really seeing the same dynamic play out in the cross currency activity in global financial markets, money markets, et cetera. So that's what I would watch for in the dollar. Eventually, there will be a bounce, but the way this chart is behaving, it's going to break hard one way or the other, in my opinion. Um, and this is where things can get kind of particularly risky for the participants involved in this market. So I'd say, I know most people don't invest in foreign exchange, or most U.S. investors aren't involved in foreign exchange. The mostly interactive with it would be like, hey, am I taking a trip to Europe or Japan, et cetera. But for the banks who have to, or financial institutions who have to operate in these markets and they're massive transactions, this is a particular area I'd say to watch where risk buildup is quietly kind of adding a lot of kindling. So keep this dollar move at the back of your mind in
I think
the weeks and months
timed your
ahead.
vacation to Japan, right? I think you went last year when the
Yeah, yeah. So this is what drives my own
uh,
wife crazy. When she says, "Oh, can we go to like Japan?" I will specifically look at foreign exchange and decide on a trip, the next 6 months out, 1 year out, based on where I expect purchasing power to be based on FX. So yeah, as you mentioned, we went to Japan back at yen levels at, let's say, 155 when it was in our favor. Now the yen has got a wind at its back. This is not the
yep.
time. You can still go live it up. Your life is finite, but in my case, I like to get more bang for my buck. So I am not looking to go to Japan this year, not looking to go to Europe, etc. Um, if you're American, probably you'll be in that same
Yeah.
situation. Watch your pocketbook, and your best vacation where your dollar is strongest is probably going to be that vacation closer to home within the United States, or if
Yeah,
you don't go to the
yeah,
U.S., go to
that's right.
Puerto
Speaking
Rico.
of which, so we're at we're at a vacation time of year. We've got Good Friday tomorrow, Easter weekend. We've got spring break. Cameron is out right now on vacation. That's why he's not with us on the channel. I don't think I called that out earlier. Um, I'm going on a domestic vacation next week, and Matt, you'll be back. But let's talk about this buy now pay later trend. You're down in the desert. You're going to attend Coachella. Matt, did you buy your tickets on BNPL? And why are people doing this? What's going on? I'm looking at the headline here. 60% of GA tickets for Coachella are sold for BNPL, which is really just installment payments. I know this is incredibly popular right now. People are stewing credit card debt, which can pile up and compound on you. And BNPL offers a different model. You actually have a set number of fixed payments. You know the charge up front. So yeah, Matt, let's get into this a little bit. Also, you're going, so who are you excited to see?
Um, Man, I don't know. Green Day is the headliner tomorrow. More my generation. So I guess I'll say something like that, right there. These new art, half of these artists, I don't even know who they are, right? I'm just going to I mean, wanted to see it. I've never been. We didn't plan our trip down here for Coachella, but hey, while it's here, I'll just go check it out. See what all this um, hoopla is all about. Um, but no, so when I saw this, yeah, it kind of lines up with a lot you've seen about, yeah, just 3 weeks ago or 4 weeks ago. The big headline was DoorDash added BNPL. So there was the burrito BNPL craze. And I think, my opinion, when I see this, it's like, okay, what you're asking, like, who is the customer here? Like, typically it's going to be like a younger cohort. And basically, what you're saying is consumption is now having to be funded on layaway, and this kind of always existed, like with store terms. People would offer,
Yeah.
what is it, layaway,
Yeah.
am I using that right? Where you'd kind of pay it down, rent to own. These things have always existed, but I think it's taken a whole new level with the fintech distribution where e-commerce, one-click shopping. Hey, if you can't pay for it, on cash debit, what do you do? Credit cards. If not, all right, we'll give you some BNPL. Um, and I just, to put this in, I always try to put things in historical circumstances, right? So, all right, what can I index this to? And what I thought about when I saw this headline was, okay, put this in the shoes of your same attendee. I'm thinking the target customer for this is some 18-year-old to, mid to late 20s who wants to go to the music festival but can't afford it, right? They don't have any savings. Um, And if I think back to those days, what if you're in 1969 going to Woodstock, right? Very similar situation. Everybody from the Northeast, um, you know, late stage of Vietnam War, all of that. They went into this massive music festival. It wasn't every year like Coachella is, but it was the draw, right? So I asked Perplexity AI, what was the cost of the ticket to Woodstock? And what it returned back for me is I think if you bought in advance, $18. And I think if you bought at the gate, I want to say it was $24. Like, okay, what does that mean in terms of purchasing power at the time? And so I looked at the minimum wage back in 1969, and it was like I want to say like a buck 60, buck 80, something like that, right? So to buy your ticket to Woodstock, which is broadly considered like the greatest music festival of the last 100 years, whatever, just recent history. Um, at that minimum wage, you would have been able to afford your ticket after like a day and a half of labor at most, which is, go out and work a day and a half. Everybody can do that. You don't really need to finance that on layaway, right? Or on Bnpl. Um, but if you look at today's ticket, the Coachella, the GA they mention here, which is called out as the 60% of those ticket purchases were funded through Bnpl. Um, $600 minimum wage. I work 4.5 days. You basically have to put in a whole work week to afford your Coachella GA ticket. So 1.5 days of work versus almost a full work week. I think that's the key difference here. And all right, you look at like the legislative kind of reaction to 2008 and what went on in the subprime mortgage crisis. Like the key thing that was supposed to protect consumers in this environment was the CFPB. This was Elizabeth Warren's baby, right? Which is supposed to be the defender of the American consumer. Um, and this is where you started to see kind of social stigma really show up for like the payday lender shops and a lot of crackdown on that for what amounts to usurious interest rates. And we're still seeing this today where, if we recall to the, election campaigns last summer, you heard Trump say things that are favorable to the low and middle class kind of worker. Um, Things like I'm going to stop taxing tips, or we can go through different policy steps that they were throwing out as incentives for voters from these cohorts to join their coalition, right? But one of the key ones from Kamala
Hey Matt,
Harris's campaign was, hey, we're
time
going
out
to
really quick.
cap
Sorry, we
credit
had a
card interest
technical
rates.
error
Yeah.
there, and we OBS dropped the feed for a second, so we're live still. We're back, but it created another live stream. So apologies to anybody still tuned in. We did get cut off. We had a bit of a technical error there. So if you're back with us, we're talking BNPL, and we'll stitch it together later.
All right. We rejoined the matrix. How long were
No,
we out? Was it like 5 minutes ago?
it was just it didn't cut off really. It just forked and created a new stream. So everyone got dropped. Yeah. So now it's showing up as a second live stream. So apologies to everybody who's rejoining us.
Okay. All right, part two. Oh no, what I was talking about was basically so post two. Did it capture what I said
Yeah,
about
it,
the
it, it got
comparison to
that.
Woodstock? Basically, a day and
Yes.
a half of work versus a week. Okay. So in the 2010s, you saw this clampdown. Hey, let's clamp down on payday lenders, and then with the Kamala Harris campaign last summer, um, the from a financial perspective, the most appealing initiative that I think she threw out as a bone to potential voters in this, young demographic cohort was, hey, we're going to cap credit card interest rates, right? It's like, so stuff like that obviously has appealed to a very stretched American consumer. Right, but when you're looking at BNPL, like what it tells me when you're like, you're just comping it to the Woodstock, just price things in labor hours, right, at minimum wage, um, a week versus a day and a half. It tells me like these things are overpriced in terms of labor time, right? Your time that it costs to go into these things, and what people are actually short on resources because prices are. Um, just so elevated essentially. um, it costs you more time to buy anything you want essentially, whether it's like you just go to the grocery store, get a bag of groceries, that'll be $100, or something like just your entertainment, you want to go hang out with your peer group at an outdoor music festival, that'll cost you a week. You want to buy a house, I don't know, that'll cost you at this point 90 something years. Like I don't know what it is, I'm just throwing it out there, but like a house to them, you see it in this quote, somewhere in this article they were talking about like the idea of ever being able to afford a home is just totally outside of the realm of possibility. The way most young people kind of perceive this, it's so far down the road, or it's so far out of what they believe is even going to be available to them. It just encourages this mindset where you're like, whatever, just put it on BNPL, just whatever, I don't care. It's never going to become reality anyway. So it creates this short-term FOMO incentive, and it just is, yeah, it's just a sign of how skewed I guess the debt situation overall and what it does to pricing, and then people's behavior. Right? It's the opposite of what you want to happen for like a strong society will be built, and its projects will be built on savings. Right? That's in the long term sense, that's how you get economic productivity, wealth creation, all the above, like just good things that people want. And this BNPL just craze. I don't know. I don't want to put myself in too down of a mood looking out at these crowds and thinking, uh, just just thinking sorry for feeling sorry for so many people out there who are just living it up for today, and just incentivized down this road to enable very
I
poor
think
long-term
to offer
economic
a, I mean,
decisions
to
is
offer a little bit of a counter,
um,
yeah, I mean, to offer a little bit of a
saddening.
counterpoint, I do think there might be in younger generations a push away from credit card debt, and that is a narrative that younger generations are actually saying, no, I don't want to rack up credit card debt because that is it's there's really no there's no I mean, there's limits, but there's no limit to how much debt you can just keep kind of rolling over and compounding. Whereas with BNPL, there is an argument to be made that it is slightly more responsible because the person saying I can't afford this right now, and I'll regret not going, but you time it up with your payday, right? So you say, okay, it's going to be 4 installments or whatever using these apps, and you say I want to do this. I know I'm going to pay it off in this amount of time, and that's it. Now, obviously, if you lose your job or you get sick, then and you're working hourly, then that's going to be a problem. But yeah, I would say that I'm not sure I would take the totally dire view looking at it because what I want to see is the overlap between people using BNPL and their credit card situation, if at all. Like how many people are actually racking up a ton of credit card debt? They've maxed that out, and then they're using BNPL to actually get this, to make these purchases. I think that would be the key question: is BNPL starting to replace revolving consumer debt that arguably might be even more harmful because it compounds insidiously, or is it replacing it, or is it augmenting it and extending it? Because I think my understanding is that there's soft credit checks for BNPL, so I could see a situation where some of that crowd is already maxed out on credit cards, and then they're extending to BNPL to get what they want today. So it something we can look into though.
No, so I'm gonna. I get it. It's not as bad as racking up a 30% or a credit card uh, pile of debt that's going to accumulate at a 30% APR and ultimately lead you into the bankruptcy process. Sure, but to say this is a positive step, right? And it's favorable.
I didn't say it's a positive
Listen,
step. I
if
said there's
it's
a
like,
different way to look at it. I'm not necessarily sure if it's you know.
yeah, yeah, in the broader scheme of like priorities and like you're actually not getting to the problem is like we need like the American worker needs to start accumulating savings, like full stop, right? And to offer a new product, we're like, oh, now we have filtered cigarettes instead of those dirty unfiltered. Well, sorry, you're still smoking cigarette. Like that's still bad for you. Like this is still you're not engaging in the culturally productive activity of like savings, right? Um, so at the end of the day, like you're just filling just a bad habit, like the same thing of smoking, right? You're giving it's just, hey, we got filtered cigarettes here, go do that. It's nothing to celebrate or be proud of, and I think just this I don't know, the whole culture. Door like well, instead of just going to the grocery store, which I know it's expensive, right? I talked about it. You go to a grocery store, you fill up one paper bag of groceries, it's $100 almost. Like I guess you could fill it with top ramen and lower that cost bill, a little bit, but your body won't thank you with the the lack of nourishment for doing so. So my point is it's expensive to go fill up food and prepare at home. But those activities, like, yeah, you shouldn't be if you can't afford the meal. And if you're using BNPL and you don't have the deposits in your bank account to pay for it, and you're just like, I'll work this off, I'll pay for it later, whatever. Like, you shouldn't be doing that. Same thing, like here, like you need to be building.
Oh, we're losing some frames here, Matt. Still there?
There's a much deeper problem.
Yeah.
I guess we'll leave it there.
On that,
Um,
what was it? On that
we'll
cheerful
get
note. Well, look, I think
we'll come back
yeah,
with a
that's right.
cigarette sponsor next
Brought to
week.
you by Philip Morris. So, well, apologies for the technical. We had a few technical difficulties today, but still some good stuff from Matt. Thank you, Matt, for going deep on this. I'll be out next week. I'll try to chime in if I can from my vacation, and Cameron and Matt will be back in the office next week with another roundup. So thanks everyone for joining us, and have hopefully everybody has a good holiday. If you celebrate Easter, a great Easter weekend with family. If not, just a nice relaxing holiday weekend, and we'll be with you next week.